Hello again, everybody. It's Harry Boxer, the technical trader from the TechTrader.com. Today, we're going to talk about risk management and how we use stop losses to prevent, any major losses in the account. Because the key to trading is always preservation of capital, so you can trade another day. All it takes is one big hit to wipe out your account, particularly if you're on margin, which I don't trade. But the point is that when people don't know, number one, to use stops, how to use stops, where you set your stops. And I think the number one thing, there's also one other thing I want to talk about. It's in terms of portfolio management, in terms of when you say risk management, never risk more than 20 to 25% of your portfolio ever in any one position. That's been my philosophy, that the best way to trade is usually you keep 20 to 25% cash pretty much at all times, unless you got some really great opportunities available. And that's the reason you keep that extra 20, 25%, because you never know when something's going to come up that's going to be an outstanding opportunity for you that you want to at least take a partial position in. But for example, you have a $100,000 portfolio. If you're going to have no more than 4 or 5 stocks in it, and you're going to have anywhere between 20 and 25,000 invested in each, that's the way I do things. I also am a big another way of inducing risk management is by being able to take a position partially at a time, meaning in tranches. For example, today we traded cardio diagnostics, and it didn't even go anywhere all day, but you see the triple top here. And then right about 12:15 during lunch hour, the stock popped and I put a buyout up. And I also said, set your stops under here. Now, when the stock popped out and broke out, I set my stop there. And then it formed a coil, a beautiful bull coil, which never broke support and actually held the trend line. Also, this dotted line is the volume weighted average price, called the VWAP, which most traders use. Note that it held it there, and then it popped and flagged, popped and flagged, popped and flagged, and basically did a stair-step move up. And we kept raising our stops to under there, under there, under there. And by the end of the day, we were able to stay in the trade all day. And I gave them a couple targets at 6.5 range, 6.5, and 7 were my targets. So sold some, and when it hit 6, I think it was 595 there. I said take a little off the table. You sold a third, and a third. And I believe in selling just like you go in tranches, meaning basically you're going to take a half or third position at a time. So we bought a third here, a third there, and a third there, and stair stepped out there, and there at an average profit of about 75 cents, or maybe upwards of $1. I haven't calculated yet because the market just closed. But of course, risk management in stocks when you're trading, day trading, is very important, because all it takes is one stock to collapse and wipe you out. On longer positions using daily charts, for example, First Solar. Now, big day today. First Solar was a big winner for us in today's trading, as it broke out over 180 and we went long. My targets were 188 and 194, and we hit 197, or close to it, by midday, and then backed up. But you can see, I want to show you what I'm getting at on the daily chart. Back in July, when the stock broke out of a base in a breakaway gap, it ran up, formed the flag, and started to break out. I set a stop right there at 95. It broke out and pulled back and started to run. We raised our stop to 103. It then broke out and pulled back and ran again. I raised my stop once again, this time to 111, under 111. And eventually, the stock spiked up and we sold the stock at 144. It then came down hard. We went back in, and you can see, if you had stayed in this stock and just kept raising your stops under the trend line, here, there, and there, the stock held every time. And today had a spectacular breakaway move on a great earnings report, moving up 26 points, or 16%, on 15.4 million, which is huge volume for First Solar. It's actually the biggest volume on First Solar on an up day going back 4 years. So this might be blow-off time or a spike up into higher levels. But what I would do today is I would take my stop, if you're not out of it, which I did recommend selling some, and raise it to here. In other words, this is too far too fast, and it's very likely to come down. But if it backs and fills in that area and keeps going, My next target, believe it or not, is 220.30 zone up here. But for now, today's stop is going to be raised to about 180.82 zone right in there. You can see how you've been in this stock since last August, never stopped out once, and the stock continues to run up, and that's how you stay in the stock. I think the number one question I get most often from traders is, how do I stay in the stock? And I think the way to stay in the stock is to properly set your stop so that if you get stopped out, you're out. In this case here, for example, it didn't break the trend line, but it did break price support, and some of our members got stopped out because I told them that support was at 160.61, and we got a quick hit to 157 before it finished at 165. So a nice 8-point reversal there, which indicated to me a bottom may be in. Then it retested and today was a big breakout. So that's the bottom line on stocks. But for the most part, when you're in any position, you enter in pieces, you exit in pieces, but more importantly, those are guided by your stop losses and the technical trends. If you're in something that breaks, also pay attention to moving averages, because when a stock does roll over, let me show you how to protect yourself on the short side. Give you a couple examples. Okay, we just went short DINO, which is Sinclair Oil, and broke down and rallied back. And then when it came down, and I sold it short around 56 with a stop at 60. It hit 59.40, never got stopped out. And you can see what happened after that, dropping down to 47.5. So a 12-point pullback. And right now, based on the fact that this is a long support level, I would say I lowered my stop on the short side from stopping out at 60 and now stopping out at 56. And should it break above that, obviously you get stopped. But if it goes lower, then I would stop it somewhere in the 52 range and continue to roll down with the stock until it hits either a target or I get stopped out. But on the short side, it's the same thing. Moving averages are critical too when they cross over and roll over on you. Here's a stock that has been ugly for a long time. And you can see that Overstock had about 8 and 9 months, almost a year of consolidation before it broke down. And notice when it rallied back up and formed a bear wedge, it never actually broke out again and started to roll over. What we did was we went short and stopped it at about 55 and then came down all the way down. I watched it bounce. I had lowered my stop, on the short side. And this went to 39.5. And it eventually went down to 16 and still looks ugly. It's one of those stocks that if you stay in it with stops, you can continue to make money on it, both short and long. Now, this one went from 110 to 1880 in about a year and a half, and it still looks lousy. So those are examples of going using stops effectively on the long and short side by just making sure that anything that rallies and then rolls over, when you want to put a stop in on the short side, you stop it above the highest high of that pattern. And on the long side, when like in the case of First Solar, one more time, the key being that if you raise your stop to underneath each support zone, you never got stopped out and you're still in it, all the way from 96 to 195, 100-point profit in about 6 months, and you're still in the stock. That's how you stay in a trade, and that's how you protect your trade. And that's my method of risk management, continuing to raise stops below the prior low in an uptrend. Because once a stock makes a lower low, it's likely that it's reversed the trend, or in many cases, I would say 3 out of 4 times when a stock reverses its moving averages, cross over, and it reverses the price pattern, it's usually time to make a move out of a stock. So that's my little spiel today on how to protect yourself using risk management via the stop loss, and also keeping in mind that the trend channels, the trend lines, when they're violated, along with moving averages being violated, usually that violates a prior low and also takes out your stop. And that's the purpose of stops, to avoid bigger losses. So you can take several losses in a row if they're small ones, but one big loss can really wipe out your portfolio. I always encourage everybody in my room at DecisionPoint.com to use stops, and I give out targets and stops on every trade that I issue. So that's it for today, and that's my talk, David.